speak to you about investors and how to talk to investors and what investors look for in startups. It's very exciting for me. And throughout my work, working with startups around the world, we found that there is usually certain basic questions everybody has. So I'm glad to kind of come here and give you my experience and talk to you about what investors look for. And this is kind of a question that we see regardless of what kind of investors you're looking at. So I'm going to go into detail about that, but I do want to say that it's a great thing to be here. I guess what we'll be doing is I'll be talking to you about investors and what they look for about 45 minutes, and then we'll make sure that we have a good 10 to 15 minutes at the end for questions and answers. So let me go ahead and pull up my presentation here, and we'll kind of go through it. And in the meantime, as this goes along, as you have questions, go ahead and put those questions in the chat or the Q&A. And at the end of my presentation, we'll just open it up for anybody who wants to ask those questions, and we'll start discussing those. So let me get through here. There we go. So I hope everybody can see that. And so again, I'm going to be talking to you guys about, from a startup perspective, what investors look for in startups. The question that we get so frequently is, how do I raise funding? Or how do I talk to get acquired? And these are some of the basic things that I've learned about and had the experience going over for the last, 15, 20 years, working internationally and the United States. And I think one of the perspectives that I hope I can bring is that not only having the experience of working with investors and startups in the United States, but internationally, working on the ground. As Burak mentioned, working in Kazakhstan, running the incubation now in New Delhi in India, but I've also worked in other countries around the world, including Hungary and Colombia and Mexico, and Portugal, Chile, Israel. So having that kind of experience and understanding that there are, no matter where you are, there are some fundamentals that investors are going to be looking at. This is what I'm here to kind of talk about to y'all. So without any further ado, let's go ahead and get started. And the first thing I want to mention is, oops, let's get this here. There we go. When we talk about what do investors look for in startups, the first thing you kind of need to do is ask yourself, what kind of investors are we talking about? Because there is a large difference between them, and you can't lump all the investors together. So I'm going to talk about here the two main investors that everybody thinks about, which is angel investing and venture capital or VC investing. And just a quick overview here. Angels are a high net worth individual. This is somebody who's a wealthy person who's got over about $1 million or more, or 2 million, and has a recurring income of about 200,000. That's kind of the definition in the United States. They will make investments in startups, but they can also group together and form syndicates so that they can leverage each other's money and make larger investments. But that's what angels are. And there's a very thriving angel network in the United States. These I've seen in different countries. There are some angels that work in different countries. It's a lot less developed. There's a lot less rules. And so the angel networks I've seen in other countries are a little bit more nascent than they are in the West. But again, we'll talk about that. The difference between angel investing and venture capitalists is very large. So a venture capitalist, a VC firm, is a partnership. It's a legal structure where you have this limited partners who invest in a fund. So they're all investing in the fund. And the general partner, who is the head of this VC firm, that is the person who will actually source and invest in deals with the whole express purpose of returning the most money to the limited partners. So it's a very different structure than just a wealthy individual or a group of wealthy individuals putting money into a startup and saying, hey, once it's successful, we'll get a percentage of that. So I'm going to talk a little bit about that. And I think it's crucial that people understand this, the difference between the VCs and the angels before they start raising funds, because you should know who you should be going towards and how these different companies from the VC side or individuals from the angel side, how they think and what their expectations are. Just like you do when you're segmenting your market and you're researching your market, you should be researching and segmenting your investors and choosing the ones who fit closely with mostly your goals and your ideas. So let's talk a little bit about angels. What is an angel and what are they usually trying to do? And I'm talking here in general, so this doesn't apply to every single angel, but in general, what you'll see with angels, it's that it's more than just the money. Again, these are wealthy individuals who've made their money and are looking now to invest in startups in their field. So for them, it may be something that they have experienced for the 20 years where they were very successful. And now they want to be still active in that field and want to promote startups or promote technologies in that area of their field. Whether perhaps they just want to give back in general. So whether it's to the industry, whether it's from their region, so Central Texas Angels, the area that would be somewhere in the United States geographically or around the world, to promote that region economically, or for a cause. So they say, okay, I want to invest in technologies for cancer or artificial intelligence or material science and nanotech, transportation, etc. So these are people that have the money, have the disposable income, are willing to invest in companies. And there's a variety of reasons for that. Angels are a really good example of what we call smart money. And this, if you've heard that term before, when you talk about investors, there's the idea that when you attract an investor for your company, it should be more than just about the money. It should be them being able to give you expertise in that field or connections to partners, to be able to mentor you in the sense that get you around these red flags or these pits or these problems that most startups have. If it was just about the money, theoretically you could go to a bank. And so the idea of an angel investor, because they're in your field, because they've already been successful, will have all this value add that they can give to you as an investor, as opposed to just writing a check, which is important, but it's not as important as what most startups need. And as a matter of fact, we see that some of those other things they do, those connections, that advice, helping you build your team, are actually more valuable than the money itself. So this is angels are usually a good example of what we call smart money, and are usually smaller amounts. And so usually earlier stage startups start off when they are looking to get investment. They start off with angel investment, and then as they grow, will kind of go to the VC investment. You'll see here down below that this is still a business transaction, and it's still investing in any new business is still risky. They understand that. You should understand that. They will take equity from you in return for their money, but that's what giving investors a partner of your company, that's what it is, regardless of whether it's VC or angels, they will be taking equity. So this is kind of an example of what an angel would be. These multi-individuals who are making smaller investments, maybe they're banding together to try to leverage their money to get larger investments in your startups, but it's really more than just the money. There's a alignment there that you should be looking for on their vision, on how they can help you, the sectors they're looking at, the experience they have. These are all things that would play heavily into how an investor looks at you and whether they're going to be making an investment in you. Now, having said that, let's talk about venture capitalists. And I joke because I have a little devil there, but I'm definitely not anti-VC. But you do have to understand their rationale, their thinking, and what they're coming from expectations. So I mentioned before that a venture capitalist firm is a legal firm. So it's an organization that brings in partners that will invest in that fund. And then the head of that VC, the general partner, will then go out and try to find startups, investment deals, with the sole purpose of basically maximizing the return to these partners, to these investors in the fund. So they invest in new companies. A normal fund will last 7 to 9 years. So they're looking at this from a timetable of maybe 5, 6, 7 years after they invest to start thinking about selling. Now, the important part of a VC company, a VC firm, that you need to understand is they're looking at their fund and they're hoping to get an average return about 20%. But the model of a VC is that, and they understand this is just the nature of young, innovative startups, is that most of these investments will fail. So take a look down at the bottom here. This is this is a very typical breakup, that if they're investing in 10 companies, they understand that 5 of those will just fail. 3 of these companies, of these 10, or we call zombie companies, they're not really alive and they're not really dead. They're just kind of there. Maybe they're breaking even, making a little bit of profit or losing a little bit. So those, again, are not going to factor into the profitability of the fund. VCs are hoping that the 1 company, the 2 company, if they do really well, 3 companies, that's the ones where they've really made a successful investment. Those are the ones that you see here that are going up on the hockey stick of growth and that are returning 10, 20, 30, 40x, 100x. That's what they're looking for, because they need that kind of numbers to be able to make an investment worthwhile of 20% across the fund. So if 8 of the companies are going to fail, those 2 not only have to be profitable at 20% for themselves, those 2 companies, but they have to make up for all those other companies as well. So once you understand, and again, this is not neither good nor bad, this is just the math and the numbers of how they will look at things. So if you are thinking, hey, I've got a great startup, I'm doing very well, I expect to get 50% growth and I have a 20% profitability year on year, I'm more than happy to give a portion of my company up to a VC. And after 3 or 4 years, I'll be able to return the capital, the investment they've given me, plus 20%. And I know that VCs are looking for 20%, so they should be happy. Well, no, they're not. And that you are not really a target for VCs, because you're one company that's made that 20%, and that's a risk. But let's say you can hit that. They still got 7 or 8 companies that did not make that. So for them, that is going to be a very iffy proposition of whether to look at you and invest in you. If the best case scenario is that after 4, 5, 6 years, they'll make 20%. So when you understand that, then there's a very different model of potential targets for investment from a VC side and an angel side. And one thing I see a lot of is that startups will come up and say, I'm really looking for VC investment. And their model of how they're going to grow and their profitability really doesn't match what a venture capitalist is looking for. So it's one of the things that we talk about, what do investors look for? This is a large difference of how an angel investor looks at a company. And they would be more than happy to say, oh yes, I see after 3 or 4 years, you can do this and I'm getting a 20% return. Versus a venture capitalist firm who has to look at the fund in general and how this will play out over 5, 6, 7 years, and how this will make money on its own, but also be a large enough return that maybe it can pay for some of the other companies who didn't do as well. So let me, having said that, kind of set the VCs versus angels. The question of what investors look for, of course, is they want high yield, low risk returns on their investment. So let's talk about a bit more specifically is when you're talking to investors. Now that we know what the goals are of each one, when you're pitching, when you're going to be laying out to the investors the rationale for investing in you, how do you do that specifically? And I'm going to go through some of these ideas in a pitch deck of what we would see and what they would be looking for. So commercialization of technologies here, we're assuming most of your tech are tech-based. And a good proportion of the startups that I work with in the startup world are technology-based. And so most of the founders are extremely smart, smarter than me, scientists, researchers who have come up with a great innovation. And now they're trying to make this work as a business. So this is commercialization of a technology. When you go to investors, you have to understand that this is really 2 different worlds you live in. So the world of scientific research, of innovation, of technology, and the investment in the business world. And even though you may have the same goals of commercializing this and bringing this technology to the market, making money and everybody's happy, you really speak 2 completely different languages. And the idea in these investments, pitch decks, or when you're speaking to somebody with a deck or without, if you're doing like an elevator pitch, is that you really have to be aware of how the other side looks at things and be almost an interpreter to make that bridge between the technology ideas and how that's going to work as a business. And I see this extremely frequently where somebody is a fantastic researcher, but they don't just understand how this will work as a business and don't know how to speak that language. So I'm going to go through a little bit here on some pitches and what we would see as great examples of how to talk to an investor. So here's some examples of different pitches. I'm going to specifically talk here about investment proposals. I'm not going to go over about elevator pitches or blitz pitches. I'm sure you've been talking about that maybe with Barak, but for me, I'm specifically focusing when you've gotten past the elevator pitch. You are now sitting down for your first meeting with the VC or the angels, and you're going to get about 5 to 15 minutes to give an overview of your company and why this would be a great investment for them. And this may be also by the fact where you met somebody at a conference and they said, great, here's my card. Send me your pitch deck. I'm interested in learning more. So again, I talk about 10 to 15 minutes, but the unfortunate reality is that it's not 15 minutes, especially if you're sending this over by email where you're not allowed to present yourself. Research has shown that actually, if you're sending a presentation to an investor, the average time they look at these things are about 3 minutes and 50 seconds. So what does that mean to you as a startup? You have a pitch deck of about 10 to 15 slides. If you're waiting if you're building the story and hey, the real important moment of why this is so interesting is on slide 10 or 11, it will not work. You have to be able to grab them in the first couple of minutes, especially if this is something, again, you're sending in and you're not there to explain. So the most important part of a startup is always, I talk about the team. But if you're not there, then that whole part of the team, that dynamism, that passion is not there. So they're flipping through this pitch deck and they've got, not because you've got a good or bad or there's a problem with your pitch deck, but they probably see 50, 60 pitch decks a week. And so they know what they're looking for. And if you don't catch them, you don't grab them in the first 2 or 3 minutes, they're going to go on to the next pitch deck. So you really got to make sure that when you have these decks, when you're talking to investors, you kind of put the focus and the grab there up front because they don't have time. You don't have time to wait to make the point at minute 10 or minute 12. Okay. This is just a general presentation outline for about a 15 slide pitch deck. It does not have to be necessarily in this order. There's no ironclad thing. You must put this and then that in the order here. But these are general topics that pretty much a basic pitch deck you have to have. So if you want to put the team up front or you want to put the financial ask or the business model closer or different, you can mix up the order. I like this order because it kind of builds like building a house. It builds the fundamentals first and then adds on. But again, it's totally up to you in the order you're going to put these. But in general, you're going to have to address these issues in any kind of presentation that you're doing to investors. Again, assuming that you're going in the 5 to 15 minute. You do not have time to talk about all of these things in a 2-minute blitz pitch or a elevator pitch. Number one is the pain of the problem you are solving. So if you don't get this right, the whole rest of your pitch deck to an investor doesn't matter. Because if you're not solving a problem that is important to the market, then the rest, there's no way to make the money out of this. So you have to sell them that the problem that you have, the problem that you are solving in the marketplace is big enough and painful enough that not only are people going to pay for it, but there's a lot of people that have the same problem and they're going to pay for this as well. So if you're trying to figure out what exactly that pain is and how to distill that, how to put that in very clear words in your pitch deck, ask yourself why you created this, how you came up with this product, this service, this innovation, and what problem were you trying to set out to solve? And when you say, oh, I did it because of this, ask yourself or have somebody else ask you the so what question to get to the real problem. Let me give you an example of some of these things. We're going to talk about the solution here. So you set up the problem, and I'm going to talk a bit more about that, but your solution. So you have the problem, and they're saying, okay, this is a big enough problem. And now here's my solution to that problem. And again, like the problem, these two things here, this is setting up your whole pitch deck, your whole idea of why you're coming to the investor and why they should care. Surprisingly, this is actually difficult to do in a very concise way. and especially using minimal technical language. Here, especially if you're a researcher or a scientist, you'll be tempted to go straight into the technical solution of your problem. And I would strongly encourage you not to do that. Here, you need to make this clear and concise so anybody can understand it. And you need to talk not about the technical features of your technology, but talk about the benefits. And when I talk benefits, I'm talking about from the point of view of your customer. So for example, if you have a new combustion engine that you're going to put in cars, and you're going to talk about the compression rate and the fuel burning rate inside the pistons, or I'm not a mechanical engineer, so I'm screwing this up, but that is not what you should be talking about right now. And you don't even want to say, on the other side, you don't want to make it so simple. It says, I have created a new, more efficient engine. Well, that doesn't tell us anything. So you need to put these benefits into very specific numbers, quantifying that benefit. So for example, you say, I improved gas mileage in your car by 17%. I have something that's more efficient for energy with an apartment or a housing complex. And you can, again, don't say it's greener, don't say it's more efficient. Take an average case, quantify it, and put that number in there so we can tell exactly what it'll mean to the customer. I will save you $240 a year in energy consumption. Here, this last one was for a medical device. I can reduce the prep time for surgeons from 1 hour to 7 minutes. These are all quantifiable benefits that you can put in, and doesn't really talk about the technical of how you're going to do it. That will come later. But right now, you're just trying to let them know that the solution will bring this specific tangible benefit to the customer. And make sure those numbers that you're bringing are relevant. So here's an example. I just this of for a slide deck, a very technical, not clear the so what question here. A lot of information here, and you may be familiar with the piezoelectric effect and how to make an actuator. And for some of you who are the engineers out there, you may say, oh my God, this is brilliant. This is fantastic. For the rest of us, and that would be 98% of us, we have no idea what we're looking at here. And when they talk about at the bottom, they're saying, oh, here is the strain amplification possible using long structures, biomorphs. Isn't that fascinating? This would be an example where I would say, so what? What does that mean? What does that mean to me? And again, I'm not saying me, Eric Agelet, but whoever your customer is, right? How is this going to affect their business? Or if it's a consumer, how is it going to affect them? Whether it's going to be more customers they're getting, lower their costs, increase their revenues, you have to make that clear link to them with the benefits of your product, service, et cetera. And this is what I mean by staying away from the technical language. Because again, in the very beginning, when you're talking to these investors, they may not be specific experts in that field. Now, they may have invested in this field and know about it in general, but they're not going to be so specific that they would know this kind of intricate, convoluted technical language, even though factually this is all true. So don't do this. Okay. Quick thing, if you're not familiar with what is a feature versus a benefit. A technical feature is how things are done. A benefit is what the result of that is. And so I just want to use a very quick example here of a watch to illustrate this difference. The feature on the dial of the watch is that maybe you have that fluorescent paint to paint the numbers. What does that do? That's an interesting feature, but what is the benefit of that? Well, the benefit of that is that fluorescent paint, you can look at the watch at night and tell what time it is. But the point here is that the illuminated dial, the illuminated numbers itself, that is not important. To the customer, the point is you can tell time at night. And there are many ways we can do that and tell time at night. One of them is this fluorescent illuminated dial of the paint. Another one may just be a button here that puts a little small light on the watch. Another one may be with the modern watches where you can, I don't know, have a Siri on your watch and say, Siri, what time is it? And Siri says, it's 10 o'clock. All of those things have the same benefit of telling time at night. And so you got to be careful not to get hung up on the features and concentrate more on the benefits. And this works for business to business as well as business to consumer. And that's why on the bottom there, I was talking about having a gold band on a watch. As a business to business, this doesn't make much sense. The watch is not going to be more functional because you have a gold band. But it all depends on who your customer is. And your investors want to know that you understand your customer. Because for certain customers, the gold band, what does that do? What is the benefit of that? Well, that's prestige factor. And that is for a certain customer, that is extremely important. And that is maybe the only reason they're buying that watch. And again, for example, you take a look at a Rolex watch that's worth tens of thousands of dollars. If you have a new watch that says, I've invented a new watch mechanism, and this watch is going to be just as accurate and just as quality as a Rolex, but it's going to cost 10 times less. So therefore, I'm going to take 20% of Rolex's market in the premier watch industry. You have misunderstood your target market, because for that target market, the cost is actually the whole benefit. They want people, when you go into a room and they see you have a Rolex, the whole point is somebody says, oh my gosh, that person can afford a Rolex. They are extremely rich. And that is an extremely important benefit of that watch. If you lower the cost of that Rolex, then that benefit is lost. So again, the reason I bring this up is when you talk to investors, they very much want to understand that you understand your target market and what is important to that target market for your product or service. Okay. So you've talked about the problem, you've talked about the solution. Now you need to talk about how big that problem is, the market opportunity. So you're going to talk about the size, the scope for investors. Don't go overboard and crazy here. If you have a technology that can be used for 5 or 6 different target markets, do not go after all of them. The point here is that investors will say, if you're going after all the markets, you're not going after any markets. We want you to focus. So choose the top one, the most interesting, whether it's profitability or size or whatever, and maybe an extra one. Show us that there are other markets here, but don't spend your whole pitch deck. Don't talk to them about all these markets. Talk about the one you're going to focus on first. And definitely when you're talking to investors, if you have interest, by interest, I mean traction. If you have already got some sales, absolutely include it. The best validation of any idea is that somebody is paying you for it. So if you have some small numbers of people buying your product or service, absolutely include it when you're discussing this with investors or when you have a pitch deck. When I said don't go crazy, here's a classic example that we had worked on. A company came out with a new cooling fan for laptop computers, and it was much more efficient than the existing fans in the laptop computer. So do not say that, and you can see right here, the laptop computer market is a $10 billion opportunity and growing. All we need is 1% of the market, and we get 3 years, and we get $100 million. That is absolutely incorrect. So you are selling cooling fans. You are not selling laptop computers. So by claiming you need only 1% of the laptop computer market, you have again vastly misjudged what your market actually is, the size of it, and of course your percentage of that. So if you came to an investor and said that, you would already be on their side. They're saying this company does not know what they're talking about. Now, if you knew how much the laptop computer is $10 billion market, but if you knew how much the cooling fan market was, how much percentage of the cooling fan is the laptop market, that's different. That's a very different. But I'm just saying this is a common mistake I see of overstating the market by taking your part, including in the larger market. And you don't want to do that. So, competition, I'm sure you've heard this, but it bears repeating one more time because no matter how much people say it, I still see it in competitions, and I still see it with startups. Never say that there is no competition. There is always competition. If you can't think of competition, just think about right now this problem you're solving. We talked about in the beginning. How do people solve this problem right now? Right? Who else is trying to solve this problem? They may not be the exact same technology. And this is the question again of the features, right? It doesn't matter how they're trying to do this, but there are people trying to solve this problem. And if actually no one is trying to solve this problem at all, then you got to ask yourself, is this a big enough problem that people need a solution or are willing to pay for? So never say you have no competition. Sometimes the hardest competition to fight is the status quo. People are doing whatever they're doing right now and they're fine with it. So be careful about this when you're putting in competition, you're saying there are no competitors. Once you have your competitors, of course, then you want to tell how you are better than them. Simple way you can do this is a matrix. This is a startup that we used back in Mexico. On the top, they talked about all the types of competition they have for fighting cancer. On the left side, you talk about the benefits. And you can see at a glance, this gives a good way in a pitch when you're talking to investors about providing a lot of information at in a very short amount of time. So if you only have this 5 minutes or 10 minutes, instead of having to discuss each of these different types of competing technologies on cancer, curing cancer, you can put them here in a graph, and on the left-hand side, choose some of the benefits that are, again, most favorable to you, and it will give you an overview very quickly of why your solution is better than other solutions that are out there. And that's something that I like to use a lot, is a matrix for just expressing a lot of information very quickly and easily. You're right. For an investor, it's very clear not only where you've been and where you're going, but how these milestones are going to be set up, whether they're technical. So you've got some technical risk, you're going through the R&D, the innovation process, financial, sales. So each of these kind of milestones you can have in their market growth needs to be put in on a roadmap. And the idea that they're giving you a certain amount of money, you need to connect that money to these milestones. So I'm getting $1 million. This will last me 8 months. And in month 2, I will have, I will launch into the market by month 3, I will have a certain percentage of sales, or maybe I'm hiring certain members. If it's early stage, maybe I've got certification or I've passed clinical trials, but matching the money that the investor is giving to you to the milestones that you will need to either get into the market or expand the market is something they're going to want to see. Basically, where are you going with my money? And then what is that going to get us at the end of 6 months, a year, 2 years? The business model, I'm not going to go over this a lot because we have a whole session just on the business model. In short, it's basically how will you make money? And do you know your customer and how they purchase your product or service? A very classic example here is, are you going to manufacture this yourself, or are you going to license this out to somebody else? Are you going to be a OEM so that you are producing this and somebody else is going to brand it and market it and they will never know your name? Or are you going to be the actual name and brand, you're going to do it yourself? Do you sell directly, or are you going through a channel? This question of how you will make money is something that investors will be extremely interested in and will focus on to understand that you understand your business and how you as a company will make money from your product or service. Intellectual property, we talk a lot about this at Nexus because it's underappreciated, and I see this underappreciation a lot of places internationally. Having said that, intellectual property is not something that is crucial for everybody. What investors really want to know is how can you defend yourself once you become successful? And in certain cases, it will absolutely be intellectual property such as patents, right? Or copyright. In other cases, it will not be. Now, there are certain things you can do, of course, like your logo, your trademarks, you can do that quite easily. But the idea is what kind of defense, once you've been successful, how can you defend yourself from other competitors coming up that may try to copy the same thing you are doing? And intellectual property, again, for some of your technologies, some of your startups, is a crucial part of it. For some of you, less so. And that will be on a case-by-case basis. If it is part of your strategy and your technology is something that should be protected by intellectual property patents, you're going to want to include that in your presentation to investors. What kind of protection you have you filed for patents, have you received those patents, where those patents are good for, very specifically to make sure who is the owner and is the ownership documented. So if you are the owner and you've got the patent, don't forget, you are separate from the company. So the company has to own this intellectual property, and that has to be documented. So these are kind of steps that you will have on your intellectual property talking to your investors about some of the defenses that you will have from competitors. The team, which again is one of the most important things for investors. It is a cliche. It is something very well known. I'll repeat it here, that investors are more likely to invest in A team and a B idea than an A idea and a B team, meaning that it's the team that is going to execute on this. And you may have the best idea in the world, but if you have a B level team to execute it, it's not going to go anywhere. So be very clear on who your team is, not just your founding team, but the expanded team. If you have boards, you have advisors, you have strategic partners, you have networks, all these should be included here. All these people who are helping you and your company launch and be successful. Another thing that I see startups are not clear about with investors is that if you are R&D based, you're innovative and you're coming up with a new technology, there will come a point where the technology risk has been solved, 95%. You're still tweaking it, but in general, you've got what the technology works. And then you will be then focusing more and more on the business side and how your team as a startup will start focusing less on the technical side and more on the business, financial, commercial side. How that's going to happen is important. And the investors are going to want to know that. And so if you, as the founder, are the brilliant technical person, at a certain point, will you continue as the CEO, or will you hand over the running of the business to somebody who understands the business? That does not mean that you will then have less equity in the company. You could still be the chief technical officer as well. You can still work for them. But again, the needs of the company at a certain point change from the technical side to the commercial side, and investors are going to want to know that. Point 3 on the alignment, that's usually a bit more on the angels. Can you work well together? They need to know that when problems come up, and problems always come up, that you can work together through it. If you are a diva, meaning it's my way or the highway all the time, a lot of investors will pass up on good opportunities just because they say, look, this is a long-term relationship. There will be ups, there will be downs, and I need to know that we can work together on this and that we can listen and work through these problems. So I've seen, or I've heard investors tell me that they've passed up on opportunities, and those opportunities made lots of money and they missed out on that because they said, when we spoke to the founders, we understood that it was not going to work, that there was a personality clash there. And they said, I do not regret passing on those opportunities. So make sure that does not mean that you have to do everything the investors tell you. Absolutely not. But you have to be able to work together with them. And remember what I said in the beginning, it's more than the money. So when you're talking to your team and you're talking to investors, how can you have leverage what they have for your team? Nobody expects that your startup team is perfect. You're a startup, but they want to know that you know where the holes are, whether that's on the commercial side, whether it's on the distribution side, on sales side, all these questions, they want to know that you know where those holes are. And if you reach out to those smart money, to the angels, and let them know, hey, we think we have a very solid technical team, but we need help on this area. Then you can leverage those networks to have them help you and suggest different people that can fill the holes in your team. So remember that again, that when you're looking at investors, it's not just about the money, it's about building that team and company and having those networks that will help you become more successful. Here's an example of a slide that again, a good slide for a team. There's a Korean company. Look on the right-hand side. So they're not giving you a lot of extra information you don't need. It just tells you their titles and it tells you how many years in the business. So it gives you a very quick and easy way of knowing that these are experienced people in that field and what they're doing inside the company. So here you've got a lot of information about the team members here. And you also see down below, they've got a consortium. So those are a network there of organizations that will help them, plus the actual team members and what their experience is. So funding the investors, of course, is going to be a big issue. And you're going to have to be ready to answer these questions of if you've raised funds already and how much have you given away, how much you're raising now, And I mentioned before on the road mapping how this money is going to be spent. So they want to see that where on the commercialization plan, how much their money will help and how much further you're going to need help beyond their fundraising. So what is your next fundraising goal? So I'm expecting to raise $1 million right now. This will last 8 months or a year, and then I'll have to go to my next round. All of these are questions that you should know. One of the things that you shouldn't do is go to an investor and saying, I'm looking to raise between $1 and $1.5 million. Well, which is it? Is it $1 million or $1.5 million? Because if you don't need $1.5 million, I'll just give you $1 million, right? It is clear that you will probably put a little buffer in there through negotiations or because you might have that negotiated down. But the range of what you're looking for, there should be very, very small, because you should be able to justify all of the money that's going to be given to you and how it's going to be used. So if you say between $1 million and $1.5 million, that's a 50% difference between $1 million and $1.5 million. Don't do that. You know exactly what you need to get you to these next stages. Put that number out there, but don't be giving a wide range of this is what I'm thinking about, because it should be pretty exact. Financials, I just want to be very, my point here is to be very careful about. Most people ask for a 3-year or 5-year P&L forecasts. Just be very careful. Numbers can raise a lot more questions than they answer. In your basic first meetings with investors, you got to be careful about trying to show all these different numbers, because it will open you up to questions that maybe you're not ready to answer at this point. We understand, investors understand, that these are forecasts. And you'll see my statement there. The only thing we know about financial forecasts is that they're always wrong. But we want to make sure that you know how to build a forecast, that you understand how a P&L works and a forecast works and a cash flow works, and that your numbers on your growth are based on something, that are not just crazy taken out of a hat. So we'll ask you about your assumptions and say, why is this? Why is that? But it's not critical that you have your human resource cost in year 4 at $100,000 versus $200,000. That is not the important part. So just be careful about these numbers. The further you get along, the 3rd year, 4th year, 5th year, they understand the craziness of those numbers and that they're really not believable. But we want to understand how you got to those numbers. So let's see. That was my alarm here to make sure that we are staying on time. The final bit, after you've gone through all of this, summing up when you're talking to investors, make sure you sum up the last slide there with a couple of the 2 or 3 points that are most important from your presentation. You're going to have the ask, say, I am looking for $1 million, what it's for. And if you have other asks, make sure you put them in there. So whether it's, of course, the investment itself, whether it's a strategic partnerships, whether you're looking for key management positions, even if you're not asking it from them, this is what the company needs. And again, from a smart money perspective, whether it's a VC or an angel, this is something else that they can provide of value to your company and make you determine which investment path you're going through. So on the last slide, put 2 or 3 things about the company that they will stick in their mind. Remember, when you're talking to investors, especially if this is a competition, there'll be 10 startups that are looking for investment before you, and after you, there'll probably be another 10 startups pitching for them. So they may not remember, you spent all this time working on this, but they may not remember you because they've listened to 20 pitches. So here is your opportunity in the last slide before you leave to hammer just 1, 2, or 3 things the most important about your startup, so at least they remember that. And the ask of what you're going to be doing. So you're repeating the ask. And of course, very simple, but I've seen mistakes do it. Don't forget your contact information on there so that they can remind you, because again, they're meeting hundreds of people at these competitions or at these pitch days, demo days. So make sure your contact information is on the actual PowerPoint that you're doing. Last slide, things to remember. Investors fund the people. It's not about the ideas, it's execution, and it's about your team. Can you execute on these plans? You have to have a plan, absolutely. The idea is interesting, that's great, but it's about your ability to execute. So focus on that. They understand that the team is not, every early stage team is not complete, but they want to understand that you understand that it's not complete and where you're going to be adding these team members as you move along towards the market. Set milestones, those can be changed. Their plans can change, but again, they want to know, the next steps, how long that's going to take, and what kind of resources, whether it's time, money, personnel, and which of those can be influenced, can be facilitated by the money they're going to be giving you. Is the founder committed to what is best for the company, not for what is best for the founder? This is what I mentioned is specifically about if you're a technical person at a certain point, you will probably be relinquishing the role to a more of a business perspective. It is very rare from the start to the end that the chief technical person, the founder, who is maybe a brilliant technical person, will continue running the company all the way to the end. Whether that end is a IPO or acquisition, whatever the case may be. Usually there's a point where they're going to hand over the day-to-day operations of that to somebody with more business experience. And finally, make sure that your alignment with the values and the sector that these investors are looking at, and be aware that this is a long-term relationship. So make sure that you can work well with them so they will want to work well with you. Again, I've seen too many projects where the investor said everything looked well, looked great from a financial side, from a market side, this all looked good, but they were jerks, and we can't work with them like that. We've got too many other opportunities, so we're going to pass on this opportunity. Again, that does not mean you have to take everything they say and do everything they say, but it is a relationship where there'll be give and take, and they have to understand that, and you have to understand that as well. So that's it for me from my slide deck to kind of give you an idea of what my experience has been with investors, what they're looking for, understand the different types of investors, and a little bit of information on the pitch deck of what we expect to see, highlighting some of the big points. And I've tried to do that in less than an hour. Usually this will take many, many more days working on pitch decks, but still. Barak, I'd love to hear from the questions and see what perhaps I can offer some advice to some of the people here with questions specifically about their startups.
So, before starting the questions, Henry also mentions in the chat box that he wants to say thanks for this brilliant presentation. I also agree with him. Thanks for the awesome and content, because it was great timing with all founders present here. We were working on mentorship sessions on their presentation and pitch decks, and this was very great clarification for and kind of great content for most of the founders because they were working on their presentation skills, also making elevator pitch. We were working on one-to-one mentorship sessions about their PowerPoint slides. That was great timing, and it was very clear and what they have to do. So also another question was they wanted to also get the slides. So my question before asking our founders questions, what are the common mistakes when do founders pitch in these meetings?
Yeah, no, it's a great question and a very relevant one because there are some common mistakes. One of the top common mistakes, again, is going too technical too early. So you saw that slide with all that information on there. And again, you may be a brilliant mechanical engineer and you're going to the investors and you want to tell them so much about this because you have so much information here and you know it makes sense. You spent years, your whole life about this. The investors do not know all this. And taking them from zero knowledge to 100% knowledge, it will not work. It'll just be overwhelming. So by going too technical too quickly, you lose the investor. And that's why I was saying you need to take a step back and say, all this technical information you have, which is about your invention, that's great. What is the point of it, right? What is the point from the customer's point of view of the problem you were solving? So try to step back and say, all of this means this. And this means to you today, right? So at the early stage, you're not going to be talking about, the manganese sulfate powder that you're adding to the photovoltaic cells to get a, solar efficiency of a 0.5% on your solar cell. I just made all that up, but the point is that's not what's interesting. What's interesting is that from a person who puts a solar panel up, now I get 10% more energy. And so I can now, reduce my energy bills by this. Or if it's a business, you can say, look, now by spending $100, you can have energy for the next 20 months at that same price, or the ROI of your solar panels drops by 10%. That's what's interesting to them. And later, of course, as they get more interested, they'll ask you how. But in the beginning, it's more about what. And the second thing that I would say is that unfortunately way too common I see in startups is they will get involved too much in the jargon, in the names that are being used today, and they get a bit too much on the big picture. And so they'll throw all these terms around without really knowing what it is. So they'll talk about the machine language and the artificial intelligence to change the paradigm. So we're thinking about a different way of bringing this to the customer. And you go through all of this, and literally at the end of the pitch, and these are like 2-minute, 3-minute pitches, I'm like, that's interesting. I have no idea what it actually is, right? And you never want to be in a position where they're like, I don't get what it is at the end of the day, right? I mean, you've thrown a lot of terms there and it's interesting, this is going to change people's lives, but what is it? Is it a software? Is it a product? Is it IoT? I mean, you've got to be very clear about what it is and what the problem it solves. So those were two of the most common errors that we see about going way too big and throwing out all this jargon and all these buzzwords without actually saying what it is. And the second one going the other way, being extremely technical. And again, not talking about the problem it solves from the customer, whether it's a business to business B2C or B2B, either way.
I also wanted to also mention about some of the slides, especially when these startups make pitching on stage or on investor meetings. And I would like to hear about your comments as well. For example, comparison slides with their competitors. Mm-hmm. I mean, they use tables and all of the services they are going to give or with their product are checked, and other ones are not. Mm-hmm. What do you think about these kinds of comparison tables?
Yeah. In general, I like comparison tables, but you're absolutely correct. Some people will take this way too far. And so everything for them is green smiley face, right? Or check mark. And everybody else is round, bad, frowny face, right? The whole point of pitch decks, the whole point of an elevator pitch is to build credibility for your startup. You as a startup have very little credibility, unfortunately. Nobody knows you. So the idea of trying to bring in competition, the idea of trying to bring in other validation of other information, the idea of talking to the market and saying, I've spoken to 20 companies, is basically to boost the credibility of your team and your technology. So they say, okay, this is worth a chance. So if you take these comparison tables and you just throw up a bunch of stuff and saying, we're all good, 100%, and everybody else is bad, I think, you lose credibility there. I've seen things with there'll be a new word processing or, an office suite of information. They're like, well, our competitor is Microsoft, but you know what? They're too big and they're ungainly. We're young and agile and we customize and all that. That's all good, but Microsoft is still just going to squash you with their foot, right? So if you put a comparison table and say, check, that we're more user-friendly and we're this, it's not credible. Now, as a startup, of course, you're going to choose the comparisons that look best for you, but make sure that they can withstand actual hard questioning. Never put anything on a slide that you can't defend. If I saw one of those, like say comparison, it's all green, and I'm like, well, wait a second, Microsoft does have 50 million licenses and you have 10. How are you going to defend that? And you're like, because we're more agile? That's not an answer. So I agree with you, Barak, that in general, I like the way of doing matrices. Comparison matrix gets a lot of information out there, but you cannot go overboard here and try to just throw up everything and saying we're 100% great and everything about a competitor is bad. That's never really the case. So you do have to be very careful about that it's realistic and that the issues you're bringing up are relevant to your customer and that you're being honest about your position versus those competitors.
And also startups and founders who pitched, who present their startups also put lots of paragraphs. What do you think about how many words or how many keywords, bullet points should be used in the slides? Because if you go, they also put the same script on the slides, and it is paragraph long, and it is difficult to see, it is difficult to read, and they sometimes put the Excel sheet directly copy paste, and I mean the financial expectations. What do you think about that?
Yes, no, you don't do that. I have a whole nother presentation, not about how to pitch, right? And showing the format of your, not the content, but how to, present your pitches. And one thing is I will bow to the great Guy Kawasaki, right? And you've heard maybe the Guy Kawasaki rule, the 10, 20, 30 rule. The point is, for me, is less is better on the pitch deck. You should never have a paragraph of text on there. The Guy Kawasaki was 10 slides, I believe, right? 20 minutes and 30 font. So less is better. You have these couple of bullet points that underline what you're saying, and then you're speaking about the rest. You never want to have a huge amount of text, because then people, first of all, it's overwhelming and you can't read it. And if they are, then they're concentrating on reading the text and they're not listening to you. And you are the most important part. And thirdly, if you were just reading off what you already put on the slide deck, then there's no need for you. You could just email that and gone home and we'd all had a beer, right? So there's never be just reading off all your slides and having this bunch of text on there. It's bullet points. It's so they can take a look at it, they get it, and then they're listening to you because you're adding all this extra information on there. But don't cut and paste and put all these texts there and have 30 bullets and have paragraphs of text. Don't be doing that. You don't have time, and it undermines your message as you're pitching.
And there are lots of questions, but I have mine in my mind because I have also faced lots of difficulties with some of the presentations who have already pitched in our earlier batch, because when they complete this program, they also update their slides and business strategies, but in earlier programs, not here. And we have seen also some presentations about the mostly products, because this is a company presentation, I think, because some of the startups made this presentation mostly technical, as you mentioned in your presentation, mostly product based. They tell about lots of things about product, and there is no time left about the company, finance team, and they think because they love their product, I understand that, but this is not a customer presentation or a client presentation or a sales pitch. It is a investor pitch. So what is the difference between a sales pitch or a investor pitch?
No, that's an interesting point, is that, and I mentioned this a bit earlier in my presentation, that no matter how good your product or your idea is, it's really not about the idea. And you need to get to the bigger thing of how does this work as a business? There are some wonderful products out there, wonderful ideas that are just not good business ideas. And from an investor's point of view, that's what they're looking at. And remember what I said, I mean, you could have a great idea and it could be a great business idea, but it still may not fit the model of a venture capitalist, right? Who needs a 20x, 30x return. There may be the market is too small. But you've got a great market. Again, from a VC perspective, different VCs will tell you different things. But when I've spoken to some VCs here, they said, look, if your basic market is not $300 million and above, don't come to us. That doesn't fit our model, because the amount of due diligence that we have to do and the amount of upside that we're looking for, if you've got a $50 million market, it's just not worth it for us. So when you're going to investors, it's about the business. It's about the opportunity. Now, your product, your idea, absolutely is part of that, of course. And so you need to talk about how that competes and how, what problem that solves for the customer. But how big that problem is, that market, how it's growing. Again, this is a business idea that you're pitching, not the product or not the specific technology. At the end of the day, the investors are going to need their money back. hopefully with a 1x or 2x or whatever it is. And so they need to understand that you understand the business of this, not just, like you said, selling this product to one person or one client. So think of it in that perspective, that they're looking at this as an investment opportunity, as a business, and you should too. And that's it's not easy. That's why we do these things, right? But yes, your product or idea is interesting, but it may not necessarily be a great business from a perspective of an investor. So keep that in mind.
Eric, we have a couple of questions, so I'm going to close. Thank you very much. We are over time, I know, from our founders. What is the most important part of the description for the seed stage of investing from our attendees, and how to explain the low income at the beginning of the startup to the investor? Low income means probably revenue or early prototype stage.
So let me take the second one first. Because you are an early stage startup, I'm not expecting that you're at unicorn status right now. So the idea is, when you say low revenue, is that because you've just started and you launched in the market, or because you've got a low profitability? You would need to describe that. So the idea that you've just launched and you've only got 100 customers, well, that's okay. I mean, as long as there is a plan and you think that 100 customer validates the problem you're doing, and you've got a plan to expand, and you've got the profitability is good per unit. So again, the business is there. It's just that you're starting out. That's understandable. What is not understandable is maybe you've only got a very small profit margin, or your capital costs are way too high for you to be sustainable for the next 5 years. Right? So again, looking at it as a business point of view, it's not a crime. It's not a bad deal for you as a small startup looking for seed investment to have low traction. If you've been there in a year and you've got low traction, then we have a problem, right? Because then it looks like the market's just not, you have to pivot somehow because you're not hitting the market sweet spot. But if you're just starting out, that's expected. That's understandable. So there's a question between the traction of how much you have, which you were starting out, and your business model. Do you understand how this will make money in general? So if there's a problem with the business model that's not profitable, or you made a mistake, that will be a question that investors will definitely ask you about, and you need to be prepared to defend that. But if it's just about traction, early traction, well, it depends on how long you've been in the market. And if you've just launched, that's not really a bad problem, because you can explain that you've just started out. So investors won't ding you on that if you're just starting. Can you repeat that first question again, Burak? I can't remember.
What is the most important part of the description for the seed stage investing?
Yeah. So don't forget that all these, I mentioned about the credibility, and I mentioned when you're doing these first investment pitches, the idea is not that the idea is not that you're going to get a check at the end of your presentation. The idea is you get to the next stage, right? So your whole idea for these seed things is to sell them on the vision of the problem you're solving, that this is a huge problem that has been unaddressed for whatever reason. So there's a large problem. So there's a large market opportunity out there. You've got a solution that meets that, and the individual solution is profitable and scalable. So once you have that, hey, it's a big problem, you've got a great solution, it's scalable and profitable, and you can defend yourself from future things. In the beginning, that is the most important thing to have, right? Because that's enough to say, interesting idea, it can work, it can grow, they need some money, they need some this, whatever, but I get it, let's talk more, right? That's what you want to be. By the time you get to, meeting number 4 or 5, we're no longer talking elevator pitches there. Then you're going to really get into it. You've got time to discuss all of this. But I'm talking about the first 10-minute, it's past the elevator pitch. So you met them at a convention. They said, this is interesting. Let's talk. The first one, maybe, right? This you need to sell them on that of the problem, the solution, scalability, and that you can defend yourself. Once you have that, that usually is more than enough to get you to the next level. Let's talk in more detail. So that's what I would say for when you're talking to these first investors for seed or pre-seed, is really selling them on this, that there's an unmet need in the market that people are willing to pay for, and you have that solution that is a profitable solution and a scalable solution.
Last question. And Gurmesh has asked the current situation about the startups. What are your thoughts about on the prospects of the events and travel tech startups with the news of potential vaccines? Or bad opportunities for investors? Is now time to get back out there and also do fundraising?
Sure. Obviously, the pandemic has caused huge disruption worldwide in the market. For event and travel startups, even more so. For some, if we did our SWOT analysis here, we would say this is a threat for a huge amount of the businesses, and an opportunity for others. And the idea of being able to create event management or travel aggregators through the new tools of using the conferences and the video conference has been huge for somebody. Is it time to get back out there? We'll see. The United States is in not a great position right now with COVID. The idea of having this vaccine is extremely promising. I think we're all very happy that it's now in the final stages, and there seem to be some other vaccines out there. The more, the better. So I do think that there is, even though I'm not convinced we will go back to where we were before. I think a lot of businesses will say, hey, I don't need to go back to that business model. I will have some portion of this stay virtual, and that includes business travel. But I do believe that once these vaccines and some of these other methods have brought down the risk substantially, I believe there is a pent-up demand for people who just have gone crazy for 8 months, and I'm one of them, right? That I can't wait to travel again. I can't wait to go out and be physically at Startup Istanbul and talk to startups. This is the kind of things that we do, and I love doing it. So I do believe that there will be, once that first risk is over, the vaccine has been distributed, and we see that it is effective. I do believe for event management and for travel, there will be a huge bump right there. Whether it will go back to where we were before COVID, I'm not convinced. So we'll have to see on that. But I do believe there will be definitely a huge bump in travel and events, just because of the pent-up demand of people saying, waiting for the risk to go down before they can go back to that. So I believe there is a great opportunity, and I think investors will also recognize that and are looking at that future with the idea of future investments.
Eric, thank you very much for the great content and also your valuable time. I will answer Sheriful last question. Do you email this slide? Sheriful, we are going to also publish this video on online, and you will be able to watch, and you will be able to probably you missed some of the slides or you wanted to understand detailedly. So you will be able to watch this great 1 hour presentation and probably understand all the details of startup presentation. So this is all answered. And Eric, thank you very much. It was very exciting to be also to host you online, and hopefully we will welcome you in Istanbul whenever this pandemic is over. And stay safe and healthy. Have a great day.
Thank you so much, Burak. It was my pleasure. Look forward to interacting the next time. Thanks again.